Let's explain. When I said it's not a stock market, it's a market of stocks. Well, what do we mean by that? Well, I've often made this claim when things get crazy, like kind of there in the market right now. What I mean by this is you don't just have to buy the stock market. And instead, what you can do is look for good companies within the market. I always say it's kind of like when you go to the grocery store. You don't have to buy everything in the grocery store. You buy what's on sale, you buy what's fresh, and so forth. The reason this is so important to understand is because individual stocks can still do well even when the broader market struggles, especially when the market gets heavily concentrated like it is today. And actually, it's been this way for probably a while here, and we keep talking about it. It's going to change. We got
Yeah, I
some
mean,
data
it's
that
been
backs
this
it
way
up.
for several years. And, I mean, this isn't the first time it happened. Again, we often talk about the tech boom, but there's also the Nifty 50. I
Yep.
mean, there's been other times in history where we've had similar stories play out. And I'll tell you, the ending of the story most of the time is not good. Right. So, again, this is why we're pointing out this information for you to, again, make you a smarter investor. But as I talked about, we do often reference the tech boom and bust as an example investors should study. And in times like this, I believe it is even more applicable. From the tech stock peak on March 27, 2000 through the end of that year, the S&P 500 fell 13.4%. It is important to remember that the S&P 500 is a market cap weighted index, which means the larger the company, the more it makes up of the index. So again, those Max 7 stocks are around a third of the market now. I mean, a very big concentration in those large tech companies. But if we instead look at the equal weighted S&P 500, where every company, I'm going to say essentially has the same weighting. I'm sure it's like, off by a little bit each week. But again, essentially the same thing. It actually gained 10.7% from March 27th through the end of 2000. So, I mean, we're talking about, what is that, about a 23, 24% differential between your market cap weighted index and your equal weighted index.
Yep. And people don't realize, and we try to talk about this, about the different things. And looking at specific sectors during that period, utilities, healthcare, and consumer staples, well, they were actually up about 40 to 45%, and tech fell about 51.8%. So it's so important to, and I try to tell people this, oh, the market's going down. I think I should invest, or I need to close the account. It's like, no, market may be down, but we could be up because we don't buy the market. And this is a big mistake that people make. And they think, oh, but it's worked. And their time horizon they think is very long, but 5 years in investing is not that long. I mean, you should be investing for 20, 30, 40 years.
Yeah, and the thing I look at is I don't want to say, go out and buy the equal weighted index, but I do believe the equal weighted index will outperform the market cap weighted index for the S&P going forward. I would, again, rather look for what we saw, like the healthcare, the utilities. Again, a 40% gain is better than a 10% gain like we saw at the equal weighted. And I think you can, again, see a similar story play out where you're going to find good opportunities where even though tech is struggling, bringing down the index, it can still have other opportunities outside of tech, like we saw during the tech bust. And the thing that we always talk about, it's been just nice for many investors to enjoy the easy ride in the S&P 500 for the last decade plus. But I do continue to believe over the next 10 years, returns will be much more subdued in the index than investors have become accustomed to. And, I'll be the first to tell you, the S&P, it has beaten us over the last 10 years. I'm confident over the next 10 years, though, we will beat the S&P 500 because the way this kind of works is you have the cyclicality. And when people come in for a presentation, we show them the cyclical nature between growth and value stocks. And they do have a cyclical relationship where value will outperform, then growth will outperform, then value. But really, since about 2008, growth stocks have outperformed. I mean, you're talking about an 18-year time period. It was the same thing we saw during the tech boom. It was a shorter time period of outperformance, but a huge spike in outperformance of growth over value. And then what happened? Reality set back in, and value had a huge outperformance. Are we in the middle of that pendulum swing once again? We know value's outperformed so far this year. I think we might finally be seeing that shift occur and actually last for once.
Yeah, and people, what they also do, when that happens, they're in the S&P 500, we'll call it, and it drops dramatically. Oh, all stocks are risky. They sell lower, and then they don't come back on the right time. And that's why we like value investing. It's a little bit smoother ride. I mean, we have talked about, on growth companies, how growth companies over the last 50 years, their worst 3-year return is, I think, a negative 55%. Value, the worst 3-year return in that time frame is about a negative 24%. So you may not like it, but you're not going to panic and sell. And that's why people just don't understand what they have. They're kind of sold on things from brokers, unfortunately. And then when real investing comes along, gee, they may not be ready for it because they think, oh, everything's too risky. Like, no, value investing is different. You're buying things on sale. Who likes to buy stuff at the high price? I don't get it.
The momentum investing has just never made sense to me. And it works for periods of time,
Period of time.
but it doesn't work all the time.
That's right.
And when it doesn't work, that momentum can also hurt you on the downside. And the thing that I wanted to point out is, I don't think the S&P 500 is going to be negative over the next 10 years. But the problem is people have become accustomed now, if you invest in the NASDAQ or the S&P, to, 13, 14, maybe 15% annual returns over a decade. I don't believe over the next decade you're going to see that happen. You could only have returns of maybe 5% per year. And if you've adjusted your lifestyle to living that way, I mean, Harrison last week talked about trying to take income in a portfolio when it's declining on the S&P. It really destroys your returns. And I think a lot of people have set themselves up for failure because they've really overextended their expectations.
Yeah, and they just don't understand. That's why they got to listen to the Smart Investing Show every week and read the newsletter, do all these important things to make you a smarter investor.